Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the accounting terms. Hope you will like, share and subscribe our video. Accounting terms 1. The first part. Accounts. Formal records that represents in words, money, unit or other units of measurement certain resources, claims to such resources, transactions or other events that results in changes to those resources and claims. Accounting period. An accounting period is a time frame or the length of time covered by a financial statement of operations and is determined by regulation and is usually a 12-month period. Inventory or goods or stock is a stock or a commodity for the entity at any given point in time and refers to all the stocks in various production stages, which includes raw materials, work in progress, maintenance, repairs and operating inventory and finished goods, and which is ready or getting ready for resale and is solely for the purpose or the intended for sale. Refers to all unsold goods lying in a business concern on any given date. Creditor. A creditor is a person or the company whom the business owes money as the company takes the possession of the goods on credit through official contract signed between the company and the creditor. Accounts payable. As we understood, creditors above, who is the person or the company whom the business owes the money for the goods supplied on credit terms. All the creditors combined together forms the accounts payables, also known as trade payables or trade creditors or sundry creditors. Debtor. A debtor is a person or a company who owes the money to the business as it takes the goods possession on credit through official contract signed between the company and the debtor. Accounts receivable. As we understood debtors above, debtors is the person or the company who owes the money to the business for the goods or services obtained on credit terms. All the debtors combined together forms the accounts receivable. Therefore, it is clear that it is the functional opposite to accounts payable, also known as trade receivables, trade debtors, sundry debtors. Business. It is an activity which involves exchange of goods or services with the intention of earning income or profit. Business transaction. It refers to any transaction, dealing, or event which involves transfer of money or money's worth between the two parties. Events like purchase and sale of goods, receipts and payments of cash, etc., are examples of business transactions. Cash transaction. When payment for any business transaction or activity is made immediately, it is called as a cash transaction. Chart of accounts. Accountants record financial transactions in a bookkeeping system known as general ledger, which we have studied just a while. A chart of accounts, or simply a COA, is a master list of all the accounts in an organization's general ledger. Five main types of accounts appears in a COA: assets, equity, expenses, liabilities and revenues. Operating expenses describes the costs that arises from a company's daily operations. Also note that these costs can be fixed or variable. Drawings. It is the value of cash or goods withdrawn from the business by the owner for his personal use. Cost of goods sold measures the direct cost, all the related costs, material and direct expenses incurred in the production of any goods or services. It is derived from the formula opening stock plus purchases less closing stock. Journal. Journal is also called as the book of original entry. All the transactions will be first recorded in this book, and then it will be transferred to the ledger or a general ledger. It is a book in which various accounts are opened and tallied or reconciled at the end of the period. Payrolls. Tracking operations that record, administrate and analyze the compensation paid to employees are collectively known as payroll in accounting. Payroll also includes fringe benefits distributed to employees and income taxes withheld from their paychecks. Voucher. Accounting transactions are recorded on the basis of source documents. If there is no voucher of a transaction, it cannot be recorded. There must be some written or authentic proof of the transaction which has taken place. The document which becomes the basis for recording business transactions in the books of accounts, is called source document. Classifications: accounting voucher and supporting voucher. Accounting vouchers. There are two main types of vouchers: payment vouchers and receipt vouchers. And these vouchers are supported by internal supporting vouchers and external supporting vouchers with verifications and approvals. Good debt. It is a debt which is fully recoverable from its customers. Doubtful debt. A debt for which recovery is doubtful or have a less chance of recovery are doubtful debts. Bad debts. A debt which is irrecoverable from the customers are known as bad debts. Check. A check is a bill of exchange in which one party orders the bank to transfer the money to the bank account of another party. It is a negotiable instrument that is covered under the Negotiable Instruments Act 1881. Generally accepted accounting principles, abbreviation as GAAP, describes a standard set of accounting practices. In the United States, privately held companies are not required to follow GAAP, but many do. However, publicly traded companies whose securities fall under SEC regulations must use GAAP standards. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FARSK. Thank you. Have a great day.